Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic aligning investing with inflation. For over 8 years, we had falling inflation in India. So, most of our investing was done duly factoring in little or limited risk from inflation. We could always be sure that inflation would not come to hurt the unit economics of several businesses. But after a very long time, we are heading into a phase where inflation will hit where it really hurts, and it will hit almost every kind of business. We will see margins contract in several businesses. We will see a reversal of that extended phase of expanding margins. From now, we could well see margins sharply contract and give us a completely different picture of the financials of companies. This has happened at the most unexpected time when investors are least prepared. If you notice what we have done in the past few years in our investing, especially in the small and mid cap category, you will note that we have expanded and we have created higher multiples. Now, these higher multiples are based on an expectation that margins will hold and growth will happen. Today, we are faced with a situation where margins may sharply contract and growth may not be as much as we would like it to be. Naturally, this would mean that if inflation sustains even for a few quarters, multiples will need to contract. So, though stocks have fallen 10 to 20% from their peak valuations in the recent weeks, they still may have a significant distance to go depending upon how badly they would be impacted by rising inflation. So, inflation is going to be the real spoiler of this long extended party we had in small and mid caps. Investors are wondering why there is no buying appetite, especially from institutions, even though stocks have fallen between 20 and 40%. The reason is that institutional investors will now have difficulty in resetting their earnings expectations. They don't know how much inflation will hurt companies and would rather wait to see how bad the damage is. So, in businesses impacted by inflation and cost spiral, they will want to wait, see how margins contract and see how that margin contraction affects earnings. Only after they are able to quantify the extent of this move, they would be able to project whether there would be further damage or whether the worst is behind. And when they reach that point, they would be more comfortable deciding what valuation the business should trade at. Until such time, it's likely that institutional inertia will be seen in small and mid caps, and you are only going to depend on what the HNI and retail will do in these spaces. This is why the trend of falling valuations, which has begun now, may last a little longer. Clearly, the culprit is inflation. So, each of us would need to now understand how much inflation will hurt individual companies we own and how much that damage will reflect in operating margins, how cost push will impact these companies, and what kind of return metrics they would create in the new normal which you are going to see now. So, you have to come to a conclusion as to what businesses will be able to provide us as stable earnings after this phase. Now, that is something which is going to be very difficult to predict now. We don't know the extent of the damage, but we know there is damage. In the absence of clarity, we will see businesses getting valued very differently. Yes, there could be misplaced valuations in some companies. You could see some companies trading at valuations which are not reflecting their fair value. It could even go below fair value. So, those would be the opportunities which we need to bet upon. So we need to be very precise in how we are going to value companies, how we are going to assess the impact of inflation on each individual company, and how much we should pay for companies in a phase where inflation is going to hurt. We need to reinvent how we are going to view inflation, and we need to align our investing to the new normal. Thank you for watching this video.